All right, good morning. Welcome everybody to our 24th Business Breakdowns with Tantalus Systems. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning into this business breakdowns conversations with Tantalus Systems CEO Peter Londa. Peter, welcome. Thanks for joining us today.
Adam, good morning. Thanks for having me.
My tag team partner for this business breakdowns is Jeff Coal. Jeff is a private investor and longtime Microcap Club member. Jeff has been with us since 2016, and we appreciate you being here. Thanks for joining us, Jeff.
Thanks for having me today, guys.
As mentioned, the business we are breaking down today is Tantalus Systems, which trades on the NASDAQ under the symbol GRID, along with, the TSX under the symbol GRID, along with the OTC in the US under the symbol TGMPF. So that's TSX and over the counter. Tantalus was originally profiled in May by Jeff himself. And Tantalus is a technology company dedicated to helping utilities modernize their distribution grids by harnessing the power of data across all their devices and systems deployed throughout the entire distribution grid, from the substation to the EV charger located behind the meter. The company offers smart grid solutions across multiple levels, intelligent connected devices, communications networks, data management, enterprise applications, and analytics. The Tantalus Grid Modernization Platform, TGMP, delivers unprecedented levels of visibility, command, and control across the utility's operations and provides a secure, flexible, and affordable path to grid modernization. TGMP is a technology architecture designed to deliver true data interoperability across new and existing devices. Tantalus has achieved a customer retention rate of 99% over multiple decades while serving as a true partner to the utilities they support and the communities they serve. That's a good enough introduction from me. And before we get into the presentation, so Peter, you've been with Tantalus since 2014, and prior to that, had a lot of success in the energy utility spaces. I'm curious just what attracted you to Tantalus and the opportunity there, and maybe how is it similar or different to your past career stops?
Well, Adam, thank you. It's hard to think it's been that long. So I joined Tantalus just after serving as CEO of another privately held company in this broader sector that we now refer to as grid modernization, and had worked through a fortunately successful sale process of that prior company. And as I was starting to think about next opportunity, Redpoint Partners out of Silicon Valley, large venture capital firm, reached out to me about the Tantalus opportunity as they were searching for some new leadership and trying to pivot the direction of the company. In spending time with Redpoint and really digging in to understand the fundamental technology and capabilities that Tantalus had at the time, Tantalus was, even though a small company, was at the forefront from innovation for the utility industry. They had, in 2013, just launched a Linux-based computing platform through a custom ASIC or system on chip. And that Linux-based platform was available to be integrated under the glass of an electric meter, in load control switches to turn on and turn off different appliances, like air conditioning units on the side of a home, as well as being integrated into distribution automation equipment to access data. And while the business was very centered on the sale of its hardware, what I saw from just track record and experience, professional experience that I had prior to, was the value of that data. And so it's been a journey for us here since I've joined, but what I saw in Tantalus was some great technologists, an ability and demonstration to innovate and bring new capabilities into the market, and the semblance of a customer base that was willing to adopt that technology. So I'd say, I like to say 10 years ago, my message to our team was, if we do our jobs well, we'll be viewed as a data company and an analytics company where the hardware enables that. So we like to say we're a hardware-enabled software company. And I'd say when I joined, it was a hardware-based business. Today, I think we're a hardware-enabled software company. And so that's what was really appealing to me.
All right, excellent. One more for me, and then we can get into the presentation. So obviously, you were private for the majority of your time at the company. That has now changed. What prompted the desire to go public?
Yeah, I'd say I chuckle because it's, I don't know if that's necessarily the intended outcome. As we were scaling the business and starting to put our arms around a number of new initiatives, we needed to further capitalize the company. When I joined, the cap structure of Tantalus looked like a traditional venture capital backed business. It had, convertible preferred class of stock on top of convertible preferred class of stock, as either investors put new money in subsequent rounds, or as the business evolved over the years, found new investors. And so when we started to sit down and think strategically about how to build an independent business that could sustain and deliver long-term value to our customers and our shareholders, we initiated a process around trying to access capital. I'd say we got really good feedback on the trajectory that we were on and the direction we were taking. The challenge was the capital structure. And I don't know, for those investors on the call that have lived through a VC model or a venture capital model, when certain investors invest over periods of time, they lock in rights and privileges vis-a-vis other shareholders. And then when you're a smaller business, you try to go out and do a fairly substantial capital raise, even if those existing investors are participating, if one of them doesn't step up as the lead, you kind of have a cascading problem through the cap table. So as we were starting to think about what was the cleanest way and the fairest way to access capital, one of our large shareholders, who is still a tremendous supporter of us, in Dave Barr at Pender Growth, I was talking with him about the opportunity to raise capital and some of the challenges that we had with cap structure. And he had floated the idea of leveraging the capital markets up in Canada and going public. And so we started to dig into it. And I'd say what we found is it just made a ton of sense for us. And so we were able to get alignment across all of our existing shareholders with a conversion and a collapse of the capital structure to get everybody to common stock vis-a-vis the rights and privileges that they had amongst themselves and had negotiated previously, and then simultaneously create a fairly clean opportunity for new investors to put capital in, not ahead of existing shareholders and not behind, but equal to. I like to say pari passu. So that's what really that's how we landed on going public. And then in the process, we were introduced to an organization that was a capital pool company. I think CPC is the way they're referred on the venture exchange. It was a relatively new, very clean organization that really didn't have baggage or hangover in sort of one of the concepts of these reverse takeovers of private going into public. And we just found that to be a very effective way that the promoters and supporters of that capital pool company were very credible and successful folks in the capital markets up in Canada. And so that's the path we went. We simultaneously did a financing alongside with the support of Canaccord and Cormark at the time, and then quickly moved to the TSX, which we thought was just a better exchange for us. So, I recall we were actually approved to be on the TSX before the venture exchange, but we did the capital pool company and then did a subsequent financing a few months later and rolled onto the TSX. So it was a whirlwind for us. And I'd say it's been, for Tantalus, it's been an effective path to both simplify cap structure, create an opportunity for new investors to participate equitably, and ultimately access more capital to scale the company.
Excellent. Thank you. That was really comprehensive. That's some great history, which we can get into a little bit further. So thank you. With that, I'd like to pass the mic to you, Peter, to go through the presentation. As a reminder to listeners, feel free to post your questions in the Q&A box by clicking on the bottom of the screen. Peter, the floor is yours.
Well, thanks, Adam. And I took note of the comprehensive. I'll do my best relative to the intent of today to move through the presentation at a higher level. I want to highlight a few things about our business that are certainly where we're focusing as a team and where we're seeing incremental traction relative to some announcements that those that have been following us for some time may have seen over the last month or so, and then certainly have adequate time for Q&A. So as a reminder, I won't go through it in detail, but we do have some forward-looking information, and just draw everyone's attention to our normal disclosures that's available in our investor deck. The presentation that's being used here is available on our website under our investor landing page. So if I move through something too quickly and you want to dig in a little bit more detail, please feel free to go to the website and download the presentation. At the highest level, Adam really summarized our business effectively. You can think of us as a technology company with a very specific purpose. And that purpose is to help the electric utility industry prepare for the future. It doesn't take a lot of time to see the implications that electrification is having on the reliability of the electric distribution grid that we all rely upon. I happen to live in the New York metropolitan area in Connecticut, fairly urban environment. And I can tell you firsthand, I've had 4 power outages in the last 3 weeks. And the inconvenience associated with that, especially in a world where we're virtual, is massive and becoming, frankly, more expensive. So our goal and our purpose is to leverage technology, hardware, software, communications capabilities to help utilities, when we say modernize the grid, gain visibility as to what's actually happening, find areas of vulnerability through data and analytics, and prioritize their capital investments, whether that's enhancing metering information, improving electric lines, upgrading equipment in a substation, or tracking distribution transformers, which unfortunately are failing at an accelerated rate. And so with that purpose and our experience and scale, we are fortunate today to help over 320 utilities modernize their distribution grid today. So we have a scaling customer base that we've been very successful through our sales efforts to continue to grow each year. I'd caveat that our focus is really in the United States today. And within the United States, our history is focusing on the public power and electric cooperative market segment. In the interest of time, I won't go into the industry today, but certainly can cover that through Q&A if it's of help. Adam, you'd referenced it. I think the greatest statistic for us beyond financial performance is the retention rate. When some companies think customer retention, they think annual. When we think about it, we're thinking in decades. And so we have a phenomenal track record of locking into a utility, convincing them that we're the right technology vendor, and then becoming from vendor to true partner as those utilities start to map out their future. And I'll get into that a little bit more detail with EPB Chattanooga that we just recently announced last week on migrating to our next generation of technology, and the continuity for our business and the visibility to scale through those relationships and through that retention is tremendous. Quick high-level financials. I think trailing 12 months is a great way to look at the business. Utilities are somewhat, their buying cycles can be a little bit extended. We obviously are always focused on driving growth in the future, but we've hit some high water marks On a trailing 12-month basis through Q1 of 2025. Please note we report Q2 in a few weeks, so we'll look forward to sharing that information in early August. But as of March 31st, almost $47 million of revenue. We report US dollars as well. Please note that. $2.2 million of positive adjusted EBITDA, 37% of total revenue from software, 25% of total revenue is recurring at over $12.5 million a year. And the balance sheet is as strong as it's ever been since I've been here at the company. In terms of why and what we're trying to do, utilities are focused on the column in the middle. How do they improve reliability? How do they reduce operating costs? How do they, to the extent that they need to, comply with regulatory initiatives? How do they integrate solar and storage and wind? How do they make us as customers more engaged, more educated, more responsive? And how do they, particularly public power and cooperatives, how do they create a more competitive community to attract business? And so a lot of folks don't think of it in this capacity, but we certainly do. Reliable, high quality power at lower cost means economic development and jobs for communities and cities. And so in many circumstances, certainly our target market, public power and co-ops, a lot of the investment that's being made is to try to make sure those cities are sustainable, not just from a carbon perspective, but sustainable from an economic perspective. And so what I like this slide, even though it's busy, the consequence of not modernizing the grid is on the left side. I won't go through it, it's self-explanatory. And the opportunities by using our technology is on the right side. So we're constantly thinking about, relative to any of these scenarios for the utility, how do we help them improve reliability? How do we help them reduce operating costs, as an example? How do we make sure that they are at the forefront of attracting people, businesses to their community? And when we think about technology, we do think of it in the context of a platform. Again, fairly, high level here, but we think of the grid at the distribution level in two ways. On the left-hand side of this slide is everything from the substation down to the meter on the side of your home or office building, wherever you may be today. That's where utilities have historically focused time and attention and dollars. And many of you may be familiar with the concept of smart metering. It's been around a long time. I'd say my iPhone has been around for a long time, yet I'm on version 16 of it, right? The first phone that I had versus the phone that I have today are astronomically different in terms of computing capability and how I use it in my day-to-day life. The same thing happens with meters. The same thing happens with distribution automation equipment, and the same thing's happening inside the substation. So as technology advances, utilities are constantly thinking about, as assets get to end of life, what's the next generation of technology and equipment they need to invest in. So the core of our business has historically focused on substation to meter. How do we embed edge computing, intelligence, and analytics in as many devices as possible, from that substation to the meter on the side of someone's home or business? Where we see great opportunity and where we see the utility industry evolving is the right-hand side of this slide. What's happening behind the meter? And so as you think about the world of electrification, we can talk data centers and the implications that have through Q&A, but at the individual level, what happens when I plug in my electric vehicle in the evening or during the day on the weekend to charge my mode of transportation? What impact does that have on the meter, on the side of my house, the power line connecting to my home, the pole top distribution transformer? And then cascade that as other folks in my community have electric vehicles, as an example. What impact does that have at the substation level? Same thing happens when we see rooftop solar. It's obviously not prolific or storage, but certain regions in Canada and the United States where it is more prevalent than other locations. What's the impact to the actual assets that the utility is responsible for on the left-hand side of this slide, the substation down to the meter. And so several years ago, it ties part and parcel to our customer relationships. Utilities approached us through our users conference, starting to express concern on the way EVs, rooftop solar, and storage was impacting the reliability of their pole top and their distribution transformers. And the market for transformers has changed astronomically since COVID in terms of cost and lead time. And so we started working with utilities as we thought about incremental growth opportunity for Tantalus on what we call the TrueSense Gateway. And so our platform today is a combination of physical device that gets deployed in the field with edge computing, a software, a set of software applications, a suite of analytics that leverage machine learning and artificial intelligence, and then effectively an operating system to make any data from our devices or frankly other devices that we can read across a communications network interoperable. So it's a comprehensive stack of hardware, software, communications networking, analytics, and then professional services. In that context, we've embedded all of that in what we call the TrueSense Gateway. And so let me jump to that quickly. So over the last 3 years, we've been on a fairly tough pilgrimage to innovate yet again and to bring a new device into the market. We're fortunate that the market opportunity has aligned to when we've brought this technology to market. We continue to validate that we have a first mover advantage for this technology. And this is a fairly comprehensive device that gets plugged into the very edge of that distribution grid at the meter socket. And from this device, we can pull samples of power quality data at a millisecond type granularity. So changes in voltage, changes in current, waveform capture, phase identification, harmonics, all things that really are important for the utility to understand. The way this device is deployed is it retrofits into any existing meter socket in North America or an ANSI compliant market and any existing meter. So the utility is not beholden now to a meter, and where we're seeing great opportunity and scale is we're helping utilities actually extend the life of a meter, extend the life of meter socket, extend the life of other assets by kind of retrofitting in between the two. And so what this device is intended to do is a couple of things. We are sort of, sorry, we need to improve our graphics a little bit, but we are accessing power quality data. So as power flows through a pole top transformer, left-hand side of this slide, and comes down to the meter socket at the home or the building, we're sampling that data and we're sampling, we're pulling, data samples of consumption, voltage, and current. And from there, we run analytics to gauge, is that transformer healthy? Is it performing properly? Is it stressing and about to fail or explode? Incremental to that, and this is where I think we've really done something, the engineering team has really done something unique in our industry, is we have also included communications behind the meter for the utility. So not using consumer Wi-Fi. We obviously all have internet and Wi-Fi for this call. But there's a large portion of the community in Canada and the United States that does not have prolific Wi-Fi in their house. They can't afford it. And so what utilities are focused on is equitable access. So what we've done is we've embedded communications capability in this device that can be injected into a home, not for purposes of Netflix and email, but for the utility to have their own communication signal to smart appliances, whether that's an EV charger, a hot water heater from GE Appliances, smart circuit breakers from one of our partners, Savant Energy, or other types of switches in the home. And for the utility, it allows them to very securely, from a cyber perspective, track what's happening at the transformer level, what's happening in the grid, and then take action behind the meter with economic incentive to you and me as consumers, or message down to me that says emergency, imbalance in the grid between supply and demand, turning off water heater. Educate me in advance so I'm not surprised. I can plan. And we're seeing utilities as we leverage in analytics, weather forecasting, from weather forecasting, changing consumption of power and changing consumption down to the appliance level, right? In advance of a storm, preheat or pre-cool a home, preheat water in anticipation of power outage. Take certain non-critical load off the grid to de-energize portions of the grid. And so it's that granular control through the device, and then where we've gained a lot of traction, our analytics and software. And it's the combination of the two. That's why I say hardware-enabled software business that's really resonating with the utility industry. We've been fairly fortunate. This device, the TrueSense Gateway, and the analytics have been developed with an advisory committee of utilities, most of which were existing customers, but we also had few utilities participate in helping us design this technology that had never purchased anything from Tantalus. The advisory committee of 9 utilities, which included EPB, represents a fairly substantial opportunity of growth for the business. So when we think about it as a small company, and certainly since I've joined Tantalus, hope's not a methodology for us. You got to time technology to the best of your ability relative to market. I've seen a number of companies in this sector that build some really cool things, but it's so far ahead of what a utility is willing or able to do, the business dies on the vine, right? It runs out of capital at some point. And so for the TrueSense Gateway, we did not want to have that scenario unfold at Tantalus. And so we built the device with a known set of customers that are planning to buy it. That doesn't mean that all advisory committee members will move forward. It doesn't mean that they'll spend $150 million. This is not backlog, but it's the visibility that we have when we started the project. And to that end, the announcement that we shared last week, which was a milestone event for Tantalus, largest contract in our company's history. The analysts covered it quite well. We're not at complete ability and flexibility to share the magnitude of the contract, but EPB Chattanooga has committed to purchase an initial 20,000 of our TrueSense Gateways. We've negotiated an option for them to scale beyond that 20,000 in the first 5 years of the deployment. There are 80,000 devices that we are targeting at that utility over a 7 to 10 year time frame. So, to get a 20,000 endpoint commitment out of the gate as we're just getting this into the field is substantial. It's a great validation that the technology works and can scale. Our goal now is to get those 20,000 moving as quickly as possible, and then try to get the next 60,000 with an EPB. But the device pricing ranges, but on a bell curve basis, about $550 USD per device, combination of hardware, software, and then about $11 per device per year thereafter. So a pretty substantial opportunity in front of us. And the model is pretty straightforward. I'm going to stop here, Jeff, after this slide and try to turn it over to Q&A. But our model is pretty straightforward. Convince the utility that we're the right folks to work with, first and foremost. From there, convince them that our devices are the right devices to access the right data at the right place at the right time. And then from that data, from that connected device, which we sell and we make margin up front, we report that as connected devices in our revenue segments, drive software and analytics, as well as professional services over time. On average, our devices are in the field for 12 to 15 years. And so once we lock a device in to a utility, it gives us great visibility into not only building a moat around that utility from a competitive perspective, but also to drive recurring revenue and incremental software and services over time. So it's, the model I think is pretty well validated at this point. We certainly continue to scale our customer base as a result. So Jeff, I may go back to our solutions slide, but I appreciate everybody dialing in and continuing to follow Tantalus. You're meeting us or participating in this call at an exciting time in our company's history, especially given announcements that validate the TrueSense Gateway with EPB, the core competencies of what's driven revenue of upgrading metering infrastructure with the city of Riverside in California, and then a great sign off and validation of our analytics with a joint action agency in Indiana that's going to roll out those analytics to 19 utilities over time. So everything's kind of coalescing really well for us, and it's like I said, we've been really fortunate and a lot of hard work yet to go.
All right, excellent. Thank you very much, Peter. That was excellent, really comprehensive. Now we can open it up for Q&A. So as a reminder, to ask your questions, feel free to post in the Q&A box by clicking at the bottom of the screen. I will kick off the Q&A portion of the webinar, and then I'll pass it along to Jeff. So let's maybe start with some low-hanging fruit here. So in terms of your end market, you talked a little bit about this. It seems like typically or historically it's been a little bit slower moving. You have to meet the customer where they are. You maybe can't grow as fast as you like. Can you just talk a little bit about navigating the utility space moving forward? Obviously, the growth runway is long, but can you just talk about what's needed to kind of keep growing in the way that you like and how you grow that customer base over time?
Yeah, well, Adam, it's a really insightful question. So let me try to give some context and perspective based on, I guess, now the 11 years at Tantalus, and before that, the company I ran, BPL Global. I got involved in that business back in 2004, 2005. So coming up on 20 years of trying to sell technology to utilities. I like to use the word deliberate instead of slow, but you're right. Utilities, they move. They're risk-averse organizations. Their goal is to try to avoid change or avoid risk and mitigate that risk, because right, if something goes wrong for the utility, it means power outage. As we see this unfortunately unfold, power outage not only is economic and inconvenient, but it also puts people's lives at risk. So when utilities start to invest in technology or deploy something, they want to make sure that it's not going to have a negative impact first and foremost. That's the way they look at it. Then from confirming there's no negative impact, then the focus becomes, okay, how quickly can they improve based on that technology? And the mindset shifts. So the sales process and trying to gain adoption, and that correlates to growth, is how effective can our team be, and how effective can we be with references to navigate around that lens of make sure this isn't going to break something. I'd say what we've been pretty effective at, Adam, over the years, certainly on the left side of this slide, is the validation of other utilities. Utilities don't traditionally compete against each other, so they're willing to share, especially across public power and co-op. So for us, references are paramount to trying to break down that barrier of a risk-averse mentality to start. And so when we think about, there's sort of two phases of growth. One is, how do we win new accounts? Last year, 31 new utilities became customers of Tantalus. On average, about 20 utilities since I've joined a year. So the customer base continues to grow. That sales process can be long for a new utility, 18, 24 months. Within that, we can manage the growth trajectory and profitability of the business by then, once we get a utility and we get them through that mindset of it's not going to break something, right? That risk aversion, then it's a how quickly can we shift their focus to accelerate and accelerate and accelerate. And so that's where I think we're getting better and better. How do we command a higher percentage of dollar spend from our captured accounts each year? How do we get them to embrace, once they get the device, the data, from the data to the software, from the software now to analytics, and be predictive in their business model? And so I think that's how we're trying to synthesize sort of the slower trajectory of growth by converting new utilities, coupled with what we see in accelerating adoption and an expansion of adoption of our capabilities with captured accounts. And so, I think that the goal internally on the core business, especially as it relates to new business wins, is I think, 10% plus growth rate would be very high in the utility sector. We can add a multiplier on that, as an example with the TrueSense Gateway, because, as we shared at the end of Q1, 33 utilities placing orders. A good chunk of those are existing customers. They're more willing to take the risk of leveraging new capability because we are trusted as a technology partner. And in certain circumstances, 9 of those utilities worked alongside us to develop it. So that's how we're trying to, I think, navigate around the buying patterns and the decisions of utilities. And I think we're getting better at figuring that out, Adam, but that's how I think we can add a force multiplier to our growth rate. And certainly within our sector of helping the utility industry become a top performer in terms of both revenue growth and then through operating leverage, EBITDA and profitability.
All right, excellent. Yeah, that's very helpful. That was going to be sort of a follow-up with that was sort of going to be a follow-up question before passing along to Jeff. So it sounds like you feel comfortable, nothing formal in terms of like a guide or something, but it sounds like you feel comfortable saying that close to 100% of your current customers are truly addressable for TrueSense. And then if that's the case, I think maybe is it directionally correct to say that you could expect the ramp up in customers, maybe to be gradual initially, but then sort of an acceleration once the solutions have been vetted by a certain number of customers or a certain group, maybe that 33, as you mentioned. Is that fair to say?
Yeah, it is, Adam, and that's the way we model it out, and that's the way we're looking at it as we think about long-term trajectory and how quickly can we as a team scale revenue and profitability for our shareholders. Some of the customers, what we're seeing is this is a little bit of luck, although the development wasn't necessarily, we were betting on luck, but we've had a number of our existing customers look at the TrueSense Gateway. We're focused on power quality and the integration of devices and control behind the meter. The TrueSense Gateway is also a collector, meaning it can read meter data from electric meters, water or gas modules, or other devices that are deployed in the field. It can read data from about 250 devices relative to the range and the proximity of those devices. A few of our long-standing customers took the device and instead of putting it at the meter socket at the side of a home, they put it in a meter socket on a utility pole. And they turned it into a collector for the communications network that we've deployed for them over the years to read other meters, to read other devices, to communicate to other distribution automation equipment. And in so doing, they're using the power quality data right behind a transformer or right in front of a transformer. We didn't think of the device as a collector, as a way of expanding a communications network. So some of our utilities have actually thought that through. And so as we think about the TrueSense Gateway, and to your question, sorry, I as you can tell, I like to provide context and maybe go too in depth on things, but there is going to be in my opinion, if we're successful, I shouldn't say if, one of our areas to drive success is to present this to all of our utilities as an incremental way to build redundancy and more reliability in the communications network that's communicating to devices already deployed. And in conjunction with that, accessing the power quality data. So not only do we get the device, right, that becomes a use case, get the device to support the existing infrastructure from Tantalus, but then also the opportunity to layer on analytics because of the power quality data. So that we didn't envision that as a use case, but our customers have brought that to us and asked us if they could do it, and the answer is 100% yes. So some utilities, some existing customers will be larger, EPB. They're going to put one, I envision 80,000 of these devices in the field. There'll be other existing customers, maybe it's a few hundred or a few thousand, but it'll drive incremental revenue for us. It gives us a lot of visibility into growth, and then more importantly, recurring revenue through the analytics.
Okay, great. Excellent. Thanks for that color. I really appreciate it. That's very helpful. All right, Jeff, I'll pass it along to you. The floor is yours. Thanks.
Thanks, Adam. And thanks, Peter, for a great overview of the company for people that aren't overly familiar with it. I've got a bunch of questions, but I want to leave ample time, Adam, for audience questions. So you'll keep me posted on that. One of the things, Peter, that I think is perhaps not fully understood in the industry, and you touched a little bit upon it, is the lack of competition. And I don't mean that come up with when you're bidding on RFQs or RFPs, and we can talk about that in a bit. But I mean lack of competition between utilities. It's a very collaborative industry. And there's a tremendous amount of sharing of information. And I'd like if you could briefly talk about it in two recent wins for the company. One, as you've been mentioning, is EPB Chattanooga, and maybe talk a little bit about how they share information amongst the TVA and the size of that organization. And then also Indiana, you had a recent win, and that was through a JAA, I believe it's a joint action agency.
Yep. Yep.
And maybe talk a little bit about how the utilities are sharing information through an organization like that.
Yeah. Thanks, Jeff. So I'll do my best to give concise answers so we can get to as many questions as possible. EPB operates within what's called the Tennessee Valley Authority. For those that may not know what TVA is, the Tennessee Valley Authority is an entity that supports 154 utilities across 7 southeastern states in the U.S. In the aggregate, it is the largest electric utility in the United States and in North America. It's substantial. Within the utility industry, and to your question on sort of the, I call it almost alliance, utilities, one system doesn't stop and another system start. More often than not, their systems are interconnected, especially through the distribution grid. Not always the case, but more often than not, there is some point of connection and handoff from one utility to another on power lines. Within public power and electric cooperatives, one of the reasons why we think it's such an appealing market segment to focus in on, even though they're smaller, which means the deal size is smaller than the large investor-owned utilities, but it is this notion of joint services. It's a notion of shared experience and shared information. So EPB, great example, first utility to deploy fiber all the way to the home. They actually deliver broadband services in Chattanooga. They owned more than 50% of the market there for broadband services, in addition to delivering electricity. They were the first within TVA to really do that. They leveraged some of our legacy technology to support that and connect that broadband, that fiber to meter for purposes of their metering infrastructure. They host utilities across TVA, now across the nation and from overseas, that are similarly making those investments in fiber. And so every time EPB does that, particularly for the Tennessee Valley Authority, because they get a ton of funding through TVA, given their size. And so the benefits that we get in terms of the dynamics among utilities, and Jeff, you saw this, I think, firsthand at our users conference, utilities are getting up and providing presentation on issues that they have or problems that they've solved using our technology, or in some circumstances, our partners' technology, and sharing that education. It is a really interesting dynamic, and the best way to describe it is shared services. When there is a storm or catastrophe, utilities that have excess inventory or excess team, they'll roll their trucks, right? They will ship inventory over to another utility on a lending program for that utility to get back up and running. And so it's that notion of kind of all in it together, particularly as it relates to regional focus, is where the sharing of information is a great element of our customer base. And then from there, I mean, we got to make sure that we take our care of our customers, and I think we do a very good job of that. The retention rate speaks to it, right? They're willing to share and say, hey, this is a problem that we had. We used this technology or this analytics tool from Tantalus to solve it. And as we see other utilities that have the same problem, our sales folks, their primary focus is to call this utility. Maybe they're neighboring, maybe they're in the same state, maybe they're in the same region, but call them and talk to them how they solved it. It helps a lot. And then on IMPA, there's another great example of that for public power, meaning utilities owned by cities. Within a state like Indiana, utilities, in addition to shared services, they try to consolidate for purchase power, even if it's down to healthcare, copper wire, anything of that order of magnitude. So, if you have a public power utility that's supporting a city of 20,000 homes, they're not going to get the attention of larger vendors. But if you take all of the public power utilities in the state and consolidate them as one, and they all bid together on certain features or capabilities or services, right now it's a larger organization. They tend to get better pricing or better support. So joint action agencies were created to really marshal shared services and shared purchasing initially. Over time, joint action agencies in many states also negotiate power purchase agreements for public power utilities because they're just focused on distribution. They don't have access to generation. And so if it's 5, 10, 15, 20, 154 utilities in the case of the Tennessee Valley Authority, now all of a sudden your purchasing power for supply agreements of electricity from generators is much more substantial. So IMPA is a joint action agency that supports utilities in Indiana, and they actually just recently made access to a few neighboring utilities in the state of Ohio. Many of those utilities are small. They have limited resources. They don't have sophisticated IT or cybersecurity personnel. And so the joint action agency is supporting those smaller utilities, and in many circumstances offering services out that the utility just can't support today. So IMPA, Indiana Municipal Power Authority, they went through our analytics tools. We support a number of the utilities within that joint auction agency, but not all of them on the device side and on our TrueConnect capabilities. But they saw the ability of not only delivering analytics around protecting transformers and improving grid reliability for the utilities that have deployed all of our solutions, but they can use those analytics at utilities that may have chosen one of our competitors. And so what the joint action agency doing is actually, right, they've purchased a license to our analytics. They are willing to host from an IT perspective for the utilities that can't afford that. And then as there are 19 utilities within that joint action agency, as those 19 utilities want to opt into the analytics, right, it immediately triggers an incremental license for Tantalus, incremental recurring revenue. The IT infrastructure that's needed, that the hosting capabilities is all paid for by the joint action agency. So it's a great example of how utilities collaborate at a state level, and then how we can be successful in gaining growth quickly. We get one joint action agency, it immediately opens up the door to sell to 19 utilities. It reduces our sales cycle, to Adam's question, increases our probability of success in scaling the company.
That's
sorry,
great.
that wasn't very short, even though I said I would be. So sorry.
That's okay, Peter. I appreciate it. One of the things I think that I know that investors like us on the call and CEOs like yourself certainly have in common is heading into a new fiscal year with some degree of certainty over a portion of your revenue. You talked or mentioned on the slide that about 25% of your revenue as of the last reporting period was annual recurring revenue. There was a figure, I believe it was 3.8 million devices that you've deployed to date that are still in the field. I believe it was Adelaide Capital's recent webinar where you said that number, the current rate is growing. I think you said about 300,000 units per year. So, rapidly approaching 4 million. Maybe you can talk a little bit about the expected life of these devices, what they're currently generating. I guess the math works out to about $3.50 or so per year. And most importantly, how TrueSense Gateway, you mentioned an $11 ARR on that device. Where you see that number going, it sounds to me like it's going to accelerate and provide that much more visibility go forward at the beginning of every fiscal year.
Yeah. So thanks, Jeff. So to disaggregate revenue, and we break our revenue down into two segments. The connected devices, that's the sale of a physical device, and then software and services. The software and services is disaggregated into a couple of different categories that are reflected in our MD&A. We have the device itself, to your question, on average, 12 to 15 years is the way we've looked at it. We're starting to see within the electric cooperative space a movement. So utilities, just a quick sidebar, they're CapEx oriented animals. Buy a device, own it, depreciate it over some period of time. Once the depreciation's out, then start to think about what's next. Since I've been at Tantalus, it was first a 15-year depreciation schedule for devices, and our devices, in some circumstances, are in the field for longer than that. And since they're driving recurring revenue, that's okay. Over the years, it went from a 15-year depreciation cycle to 12 years. In starting to meet with some electric cooperative utilities, we're starting to see a migration to 8 years, meaning the utility is going to depreciate faster, which effectively gives an earlier opportunity to refresh devices, not necessarily in terms of rotating out, but being in a position where if within 8 years from now, our new ASIC or next ASIC just has had that much more computing power and capability, they have a path to upgrade to that device beyond firmware updates like your iPhone, which go through periodic updates over the year, and our devices do the same. So the devices for us, I'd say we've historically seen 12 to 15. I don't think that will change. What I do think is changing is utilities are starting to get their arms around advancements in computing capability. And so being in a position to leverage advanced computing capabilities sooner. To that end, though, within our revenue profile, through Q1, about 30, I'm going to use the number 35%. It was actually 37% through Q1, but about 35% of total revenue is software and services, so higher margin, and of total revenue, 25% recurring. To that end, when we sell a device, we've been fortunate in our model, Jeff. The TrueSense Gateway not yet reflected in these numbers, but you'll see, once a device is in the field for that 12 to 15-year time frame, we are generating revenue on the software license embedded on that device every year thereafter. And so it creates a very predictable scale of revenue for us, especially when you think about our retention rate of customers. So since 2016, really when we started to pivot the business and be in a position to leverage software after I joined in 2014, we've seen a really nice steady growth of our recurring revenue. It's a direct correlation to getting more devices deployed in the field. And so for the TrueSense Gateway, every device will trigger incremental recurring revenue. The target is $11. I could see some utilities negotiating that with us, especially the earlier movers. But the intent is get the device in the field and then monetize the data through recurring revenue on our software and analytics capabilities over the next decade. And so I think we're in a very good position to continue to drive recurring revenue. It's inherent in the model, and it's inherent in the progress that we're making with our customers.
That's great. Thanks. This order that you got from EPB was certainly a great start. I know that there must be some internal and external expectations that this is just the beginning. How is the company positioned to be able to deal with a growth cycle that I think you're entering, as far as personnel and working capital and ability to deliver and of course continue to delight your customers?
Yeah. So growth for small companies is exciting. It's also can be challenging. So here's how we're trying to dissect it. within our model, we've had a long-standing contract manufacturer. They're based in the Philippines. Devices are built there. They're then shipped into the United States. The terms that we've negotiated with our contract manufacturer are they invoice us once the finished good is shipped from their factory, and on a net basis, about 90-day payment terms. You'll see various times of the year, it could be 100 or 110 days on average. They've been pretty flexible with us over the years. The inverse, though, when a utility purchases something from us, the device, we invoice when that device leaves the factory as well. And our payment terms with utilities is about net 30. Sometimes it can spill into 40, 45 days. We have a few utilities that are in the Caribbean basin that struggle to pay bills, but they pay them. They're on island time. They pay them as they can. We continue to provide support to them. So you see some wonky things within DSO and DPO as a result. But as we think about growth cycle, we're consistently kind of at a positive net working capital. It's through our contracting, the payment terms to contract manufacturer versus the collection from customers. Worst case, 45 days from customer, best case, 110 days to contract manufacturer, the payable. So that inherently gives us some flexibility to scale and invest in anticipation of or build inventory in anticipation of next order or accelerated deployment at a utility. It's a really unique feature within the model itself, which means we're not CapEx heavy, and it means we don't necessarily have to go out and dilute shareholders by raising money to support the EPB contract. Where I see a little bit more challenge, Jeff, is personnel. So as we're starting to get more volume and deployment with the TrueSense Gateway, where we need to be really conscious is making sure we don't burn out our project managers and our field service engineering support that are, that we're not running bucket trucks. We're not doing installation, but it's the project managers that have to manage an increasing number of accounts or an increasing number of technology deployments within an account. And it's a field service support to train and educate and troubleshoot. So I think that's where we're really starting to focus our time and attention on how we make sure we don't burn out the people that we've got and simultaneously attract new talent as we scale.
Great. Thanks, Peter. Two quick questions from me, and then we're going to open up to a couple of questions from the audience, if that's okay.
Yeah, I've got more time.
Perfect. You mentioned recently the lack of competition that has shown up at some of your recent wins. You've announced, I think, 3 of them in the last 6 weeks or so. If you could briefly just talk about why that is, like where's everybody that's coming for your lunch?
Yeah, it's a great question, Jeff, and one that we're I'd say I live as exciting as those announcements are. I'm also simultaneously focused on not only opportunity but what do we not know, or where we might get surprised. So I'd say a few things on that. As it relates to the core business and what we've been doing historically, we see a fairly robust amount of competition from larger companies. We still are very successful against them. And that's on the left-hand side of this slide. We don't build a meter today. We don't own a meter today. We partner with 3 meter manufacturers, Itron, publicly traded on NASDAQ, Landis+Gyr, a Swiss publicly traded company that, as I understand, is delisting there and trying to figure out what to do as a potentially private company. And then Aclara was GE, became Aclara Metering, and is now a division of Hubbell, which is publicly traded on the New York Stock Exchange. So big companies. In addition to partnering with those utilities, we see competition. They've got their own edge computing capabilities. Where I'd say the difference is our focus is on data. We're opinionated about the ASIC. We're opinionated about the computing capabilities that are needed on a device. We're not opinionated about the meter itself. Whereas the meter manufacturers, right, their history is a factory building meters. And so they are device centric. And even though they see the opportunity in many ways through us of, okay, you sell the device, how do you actually monetize that device over time with software and analytics or services? You know, we see them building that. Itron, fairly, progressive about that, and what they now call their outcomes division is really what's competitive to Tantalus, where they're focusing their time and attention. So we see competition there. I think we've navigated it quite well as a small company, continue to operate with sharp elbows. For the TrueSense Gateway, I'd say a couple of things. I don't see meter manufacturers moving into this space. And the reason for it is, by definition, you don't have to replace the meter. You know, I really like this graphic. It should hopefully tell the story a little bit. If a utility deploys our TrueSense Gateway, they arguably never have to touch that meter again. That's the antithesis of what a meter company wants. A meter company wants that meter depreciated over a period of time and ripped and replaced. And so that still may happen. Still, utilities are going to do that. But there are also going to be a number of utilities that look, instead of a 10 to 15 year horizon or 10 to 12 year horizon, how do they get to a 20-year horizon with that meter? So I don't see meter companies necessarily, and we don't get the sense that meter companies are going to focus on something competitive to the TrueSense Gateway. I could see them trying to enhance the capabilities of their meters, but the meter, the physical elements of the meter, don't permit the same level of data sampling that we can capture in a TrueSense Gateway, or the same level of communications behind the meter. So I think we're going to have a competitive advantage, even as meter companies think about trying to do some of the same things in the meter itself. As it relates to the broader, competitive threats that we see, there are a couple smaller venture-backed companies that are mostly focused on how do they help either homeowner or utility integrate solar and EV chargers and storage. Two startups, or not startups, they've been around for some time, but two venture-backed companies. One's called Utilidata, the other GRID.TO. And then I wouldn't say they're competitive by nature, but Tesla is trying to figure out a device that can turn a home with a Tesla vehicle, Tesla rooftop solar, and their Powerwall, pretty slick little storage device, into a little mini microgrid. For us, we already have that capability through the TrueSense Gateway. We could turn a home into a virtual peaking power plant effectively for utilities today. So we're paying attention to what utilities are doing behind the meter. Those organizations more are focused on the distributed energy resources than the whole home. On the analytics side, the IMPA release included a quote from a guy named David Spiegler. David he's not affiliated to Tantalus in any way. He is a multi-decade consultant to the utility industry. He advises utilities on the selection of vendors. He advises utilities on their journey for grid modernization. I think we've asked him to do some analysis on our analytics, and the feedback that we get from the utilities he supports is we are just far in advance ahead of where others are on analytics, because I think we've been working on it for 10 years. Jeff, it's when I kind of joined, it was we're going to become a data-driven company, and from that data, we are going to monetize it through software and analytics, and it takes time to figure that stuff out. So I think we've got some leads there. It doesn't mean others won't catch up or larger companies surpass at some point, but I think we've got an opportunity to really carve out our niche and carve out our revenue stream.
Thanks very much, Peter. I'm going to turn it over to Adam for a couple of Q&A from the audience, if that's okay. Adam? Adam, you there? Okay.
Yep.
Maybe I'll just. Oh,
great. Yeah, so we'll go a little bit over today, if that's okay with you, Peter. We might not get to all the audience questions, but there's some good ones coming in that I do want to get to. So you did cover some of this a little bit, but there's some questions surrounding your customer budget. So where your products fall in utility CapEx budget or operating budget, and which customer categories are more sensitive to each. And on the theme of kind of customer buying behaviors, you said previously that a new product maybe has a 3 to 4 year payback for your customers. And the question is, does that meet your customers' financial hurdle rates, or do the public power utilities have similar issues to the IOUs where payback may not be relevant? So maybe we can start there. Obviously, there's a couple of things wrapped in one. Happy to drill down on each specific if you need me to.
Okay, so let me see if I can cover it, and if I don't get it all, you can keep me honest here by making sure we check the boxes on each one. So as it relates to budget, we hit both. When a utility is deploying a device, it's going to hit their CapEx budget. The services, technical support agreement, and the recurring revenue then hits their OpEx side of the budget for the most part. There are some circumstances where a utility may look to, when they're buying our system, a 5-year term license, or a 5-year service agreement, as an example. In those circumstances, utilities could capitalize what otherwise becomes recurring to us. We don't see that often yet. I think as utilities start to embrace more and get more comfortable with the concept of a SaaS offering, we'll see more of that. For us, it's we've got to be very prudent in how we then price that, and then from pricing it, account for it properly. But we do hit both sides of the budget, both the CapEx side for the physical device, the OpEx side for the ongoing software and support and maintenance agreements that utilities enter into with us. As it relates to return on investment, I think, Adam, there may have been something in between there, but let me cover the ROI. Yeah, I'd say there's a bell curve there, depending on the utility, depending on their purchase agreement, depending on where they operate. The ROI could be as quick as 2 years, arguably, right? We probably then aren't charging enough. At the same token, 3 to 4 year in the landscape of utility, at least from my experience over the last 20 years, is pretty substantial. Most utilities target an 8 to 10 year on most of their heavy equipment, which is, again, the way that they look at the world. When I joined Tantalus, every deployment, the utility purchased servers and put them on racks. Think about how archaic that is in today's environment of cloud computing. In 2024, of the 31 utilities that activated systems or started, selected us and started to activate systems with us, 29 are hosted and cloud-based. 2 are physical servers in a closet. So we're starting to see the migration from on-premise to hosted, from hosted, I think, to SaaS. And so as that SaaS offering, particularly through the analytics, materializes for the utilities and for us, we'll have to think through how we filter through their budgeting process. But I think the ROI is spot on. I think when they compare us to other options, we tend to look more favorable in terms of a return on investment. And I'd say I didn't quite understand that the last aspect of the regulatory IOU versus public power. Public power and electric cooperatives are making decisions outside of a regulatory regime. The regulators within a state are not setting their rate case and not setting their prices. Public power is owned by cities. Cooperatives are owned by members. Both of those utilities are 100% making decisions based on ROI. And so very specific to it. It's a fundamentally different market than the IOU space.
Okay, great. Thank you. Some questions on R&D. So now that TrueSense product development is complete, what do you think the normalized annual spend for R&D is? I think it's been reduced to around 12 to 15% of revenue versus 20-25% historically. Is that kind of a fair range to model over the next, say, 12, 24 months?
Yeah, I was just flipping to our financial slides here to see if we had we don't have an OpEx breakout, but a comp for OpEx. So what we've shared and what we continue to see is when we were in the thick of developing the TrueSense Gateway, we were allocating about $5 million a year. It was $15 million spread over 3 years, not exactly 5 per year because we didn't start on a January 1st at the beginning. But within that, about $1.5 million to $2 million each year was for external expenditures, consultants or contractors that have very specialized areas of expertise, prototyping that was necessary to get the device built, certification processes. Unless we fundamentally change the design of the device, we don't need to go through that again. So what we've seen is that sort of $1.5 to $2 million of R&D spend come out of the operating expenses. What we have not done is eliminated the balance of that, which is our own internal people. We're not eliminating headcount in our R&D because they're effectively being allocated now to other projects, as well as trying to think through how we reduce cost on the TrueSense Gateway when we think of bill of materials in volume, or allocating more time to the analytics for those that were more on the firmware and software side of this development effort. So, I think certainly Q4 of last year, Q1 of this year, Q2 coming is a more normalized rate as folks want to look at quarterly information, and sort of a trailing 12-month basis will kind of catch up to it. But I don't have the specific number off the top of my head in terms of what we spend in R&D each year, but it's normalized back to where we were before the TrueSense Gateway.
Okay, excellent. And then on the ARR side, is that sort of trailing 12 months, 20% growth a fair yardstick for modeling moving forward, or how are you thinking about that?
So yes and no. From a growth rate perspective, I think that's a fair yardstick. Maintaining 20% growth a year for 5 years into the future, that ain't an easy pill to swallow. But at the same token, it's the way the model. You can see the slope here. Certainly 1, 2, 3, 4, the last 4 years since 2021, that growth rate's been in excess of 20% a year. The more devices we deploy, it automatically triggers immediate recurring revenue on the device itself. As we continue to gain success with analytics, that's incremental recurring revenue on a per device basis. So I think it is fair. It's certainly an internal bogey that we have to maintain this trajectory of growth of recurring revenue. What might change is the aggregate percent of total revenue as the TrueSense Gateway starts to really materialize. If you think about the TrueSense Gateway, $500 is on average. $500 is going to hit the connected devices line item. $50 is going to hit the software line item, and then a year after that is where recurring revenue kicks in. So if we really start to see an accelerated growth rate of TrueSense Gateways, it takes a little while for the recurring revenue to kick in and scale. So that the aggregate percentage of total revenue may get adjusted, but I still think that the actual recurring revenue growth rate certainly can be maintained, if not hopefully accelerated.
Okay, great. Thank you. We'll wrap up with the next 1 or 2 questions. And again, we really appreciate your time and going a little bit over here. So thanks again. On the balance sheet side, how are you feeling about current liquidity in terms of bidding on the contracts that you're interested in? Is there kind of a higher level of liquidity that would allow you to access more procurement, or can you just talk a little bit about how you're feeling about kind of the growth path moving forward and how well set up you are to handle that?
Yeah, so at the end of Q1, high water mark in terms of cash. Subsequent event to Q1, we'd shared during our earnings call that we used some of the cash to pay down the outstanding balance of our revolving line of credit with Comerica. So it was a dollar for dollar adjustment, cash and now debt availability. What I'd say is we at the end of Q1 had about $20 million of total liquidity, and that's the way we're thinking about it. Certainly with the addition of Azim Lalani as our new CFO, coming from a few businesses over the last 2 decades of his career that are multi-billion dollar institutions. So I'd say we investors should assume, and we've been pretty, I think, consistent in our messaging, that we kind of see the same level of liquidity through Q2 in around that $20 million mark. Maybe it's a little bit less, maybe it's a little bit more, between cash and then what we can borrow with our working capital line of credit today. So I think the balance sheet's in good shape. It's the strongest it's been in my tenure here at Tantalus. We don't necessarily need capital to go out and win projects. What I would say is I am mindful that as we start to get the attention of some larger utilities with the TrueSense Gateway, a few IOUs as an example, one we've been public about, United Illuminating, a project here in Connecticut. Utilities have a tendency to look at companies' balance sheets in their risk assessment. Balance sheet strength is important. If it makes sense at some point, continuing to strengthen the balance sheet, whether that's paying down more of the debt or just bolstering cash and liquidity, we'll cross that bridge if we get there, Adam. But we don't need capital to support the growth trajectory that we see over the next year or two with the TrueSense Gateway coming and starting to advance. We've got a shelf prospectus that we put in place in normal course with our quarterly filings, but that's available to us. But yeah, I think we're in pretty good shape at this point, unless we have a defined use of proceeds. I don't see us. I don't envision us diluting shareholders.
Excellent. That's a good answer for a lot of us who are involved. So thank you very much.
Yep.
That's a great place to wrap it up. Again, we really appreciate your time. This was really comprehensive. Thanks again for spending a chunk of your day, Jeff and Peter. We really appreciate it. And we will post the recording on YouTube as soon as it's available. So thanks again very much,
Yeah,
and
Adam.
have a good rest of the week.
Yeah, sorry I consumed everybody else's time by being too long-winded, but or comprehensive, I think is the way to put it. But it's Adam and Jeff, thank you too for allocating time and continuing to help us build awareness.
Thank
Thanks,
you so
Peter.
much.
Thanks, Adam.
Okay.
Thanks, Jeff.
Have a
Take
great
care.
day.